Binky, I want to start on the race story because you wrote a piece of research recently that I think is really important to get our heads around. What higher rates can achieve, what lower rates can achieve, and the misconceptions around lower rates and higher equity markets. Just run us through it, Binky.
Sure. What I would say is basically, I would say one of the greatest misconceptions out there is that lower rates mean higher equity multiples. If you look historically, you can start by basically just, looking across the oceans and you see lower interest rates in Europe, lower interest rates in Japan, but you also see basically lower multiples rather than higher multiples. If you look at the US today and you look at where interest rates were for the 6 years after the financial crisis, multiples were 25–30% lower than where we are today. I think also, the big issue that everybody has or, saw in their textbook is that when interest rates go down, the equity discount rate goes down. And so multiples should basically be higher. I think what that argument misses is that the equity discount rate is, yes, the treasury yield, but it's also the much, much bigger component, which is the equity risk premium. And if you look at the relationship between the 10-year yield and the equity risk premium, they're very strongly negatively correlated in general. And so, when interest rates are down, what that's simply saying is that when interest rates are down, there's generally a pretty good reason for why interest rates are down. Now, they have, of course, been rising, and equity markets, yes, we are off of the peak a little bit, but I would say it's just really not very much. So for us, rates are really a rotation story. That's part of the playbook that's playing out right now.
This is a compositional story as well, Stephen. When growth is scarce, growth is expensive. And if the index is made up of growth names, the United States, it'll do well. And if it's not, Europe, Japan, it won't. Does that explain some of that divergence too, Stephen?
I think it does. I think last year was clearly a year when everybody was looking for those secular growth stories. What we're seeing now under the surface is actually a good thing. The more cyclical recovery that we're seeing in sectors like energy, industrials, and financials tells us that that actual economic recovery, that post-pandemic recovery, not just in the US, but around the world, is beginning to play out. But as you said, when you think about the composition of the US equity market, where it's not just the 30% in tech, but another 15% in healthcare, and another large chunk in some of the communication tech-related names, that may be a headwind for US markets in the near term. On the other side, what it means is that other markets around the world, and we really like emerging markets that have a little bit more of that cyclical value component, could do well. The last piece I would point out, Jonathan, is that for most investors who have not only been piling into tech and growth over the last couple of years, add in the outperformance that you've seen from those parts of the market. And today, that's such a big part of so many investors' portfolios that we think this natural rotation is actually healthy.
So just listening to the both of you, it seems the risk is at the index level, the opportunity is beneath the surface. And I guess, Binky, that speaks to your 39.50 price target. I was talking about it last week. We were there. Yet these price targets haven't changed because it's not really about what you're expecting on the headline number. It's the churn beneath. And I look at the overweights. It's the cyclicals, the energies, the financials, the materials, the industrials. Is that why you just maintain with 39.50, Binky? The opportunities beneath the surface.
Yeah, I think the way to think about where the S&P 500 goes over the course of the year is really, very, very strong earnings. We've had an earnings number of $194 for the S&P 500 for this year. The last time I looked at the top-down strategist table, it was still the highest number on the street. We've seen the risks to basically our numbers since we published it in December, as being to the upside, and it does not factor in the stimulus package that is being discussed or on the table today. So I would say the risks are still pretty clearly, to the upside. I think the real issue is what happens to multiples. As I think everybody knows, they are very, very elevated. And so there is going to be some extent of, a multiple derating. The question is how much and what is going to basically...
Well, Binky, let me jump in just quickly because Jonathan Goller of Credit Suisse published that very research this morning. He's expecting that contraction on multiples. He's just expecting the earnings growth to rip. Are you looking for the same thing?
Absolutely. We have earnings going up by, in round numbers, about 40% for this year. And we have, multiples coming down, but remaining basically elevated. I think one of the things to note with a lot of people calling for a correction, and there's, lots of reasons for a correction, but I would basically say that, if you look historically, valuation corrections basically happen in slow motion, and that is that equity prices just go up by less than earnings. So it is pretty typical coming out of a downturn or a recession to see multiples, pretty elevated.